Welcome to Pixalearn. We offer expert-led courses for CPA, EA, and other professional certifications to help you advance your career.
Today, we're going to talk about a very important issue which tends to confuse a lot of people. Today, we're going to talk about the difference between net income, OCI, comprehensive income, and AOCI. So, four important terms. And this is applicable for every accounting standard, Ind AS, IFRS, US GAAP. For every standard, it's important that we understand the difference between these four concepts. Now, before we get into the technicalities of these, I want to establish one very simple thing, right? Now, we all know that it was a balance sheet that was discovered first. And the idea was, it's a simple thing, right? We just have A is equal to L plus as a simple balancing equation. So whatever a business enterprise owes, it has to give it back to either the external or the internal shareholders. Now this keeps moving, and this shows you the net worth of the organization since the time the organization came into picture. But then we have something called the income statement or the profit and loss statement, which we also term as the statement of operations. And every year we let the users know how much did we earn. That means how well did we deploy these assets in order to generate the top line. And then how did we manage our expenses to ensure that there is a net profit, which we also term as a net income. And this net income does what? This net income is the performance for the particular year, and this net income is actually routed into a portion of equity which is termed as retained earnings. Now, in other words, what we are actually trying to tell you is that since the time the business is originating, we have a balance sheet, and if we just drill down on the equity section of the balance sheet, we have contributed capital and we have earned capital. So what is the contributed capital? Contributed capital is the capital that the business was established, and these are the ones that are contributed by the stakeholders. So here you'll typically have equity share capital or common stock at par, as we call it. And we also have something which in India is termed as share premium, but we also term it additional paid in capital account. So both of these, if you combine together, this gives us contributed capital. This is the capital contributed by the initial owners. And then we need to figure out what was the earned capital. So what is the money that the business grew? And this money is still retained in the business. It has not been given away to the stakeholders. So what we do every year, we establish a balance sheet, which we keep continuing year on year. So that gives us the cumulative financial operation, so cumulative financial position of the business as on today, starting from the day when the business came into picture. And every year we have the net earned income, which is for the year. We start a fresh P&L for the year and then we close it. So this P&L loses its identity, and this gets accumulated into something which is termed as retained earnings. Now we all know this, right? We know that balance sheet is a point statement, income statement is a period statement, and then we are slapping the result of the income statement to the balance sheet year on year. Now the same concept, actually, if you look at it, we realized that there are certain items which does change the valuation of your asset either up or down, are still not ready to be routed through the income statement. Why? Because these are unrealized. Now I'll give you an example for this. So what we did here was net income, and net income in the P&L, and this is flowing into retained earnings statement, which is typically the statement which goes as an earned capital in your balance sheet. So we know that this happens. So the relationship between net income, retained earnings, and equity, we are very clear. Now what we're trying to do is we're trying to establish a parallel. And we are saying that, see, sometimes, and I'll give you two examples for this, okay? Sometimes when you look at the balance sheet and when you look at the income statement or profit and loss statement, as you call it, there are certain items which go and hits your assets which may either increase your asset or decrease your asset. But these are all quote unquote unrealized. These are assets increase and decreases, which has actually not come in form of cash or something which is very tangible to the business as yet. Let me give you two examples. The first and a very clear example is, imagine you had an investment, and that investment you bought for, let's say, $100 or 100 rupee, whatever you call it. The unit is 100. Now this investment, we did not buy it for holding till eternity. And just to remove all the differences between Ind AS and IFRS and US GAAP, just assume, for instance, that this investment was in debt securities. So we are having an investment in bonds, which we don't want to liquidate very soon. We're just holding on to that bond, and we're not too sure whether we are going to hold it till maturity, but we're not too sure that we're going to sell it off immediately also. So technically, we classify it as something called available for sale bonds. Now, that's a different issue, but just understand the concept of where OCI comes into picture. So you have a set of investment which you bought at $100, and at that point of time, you would have written investments to cash. Now those investments grew in value. And imagine this 100, and just for the sake of absurdity, imagine this 100 became $10,000. Possible, right? So these investments are now worth $10,000 in your books. So what would happen? Suddenly your investments have way above value than what is showing in your books. But again, this is the value in air, right? Because at the end of the day, you really don't know by the time you sell it, whether it be 10,000, it can go down to 100, or it can go down to 50, right? You don't know that. It's all in thin air. But at the same time, we have a level 1 input. That means we have a sure shot proof that these investments are actually worth $10,000. So what do? We say that no, we don't want to carry the investments at historical cost. Why? Because we know for sure, and there is an external proof that lets us know that the investments value have increased. So US GAAP, Ind AS, IFRS, we come up and say, okay, we will let you increase the value of the asset, but we will not let you put it in the income statement. Why? The key word here is because it is unrealized. We have not realize this gain in cash because the investments have not been sold. So what do? We allow you to book it, but we have created a portion of your equity, and this portion is again earned equity. It is not a part of contributed capital, and this we have created a bucket, and we call it AOCI, accumulated other comprehensive income. Now see, this is a fancy stuff. You could have called it anything. What we're trying to tell you is, I want you to show it as a part of my equity. The idea is we let you increase the asset and we let you increase the equity. Now, the moment we just increase something in equity, we also want it to be visible in the income statement. So what do we say? We say, okay, forget about your net income. You have a net income for the year, which is equal to your revenue minus your expenses. And we know this, right? So we remove this for the time being. So what do we say is, why don't you do something? For all of these movements, show me the picture in the income statement itself. Why? Because there is a profit, right? So imagine what we are trying to tell you is that $9,900, there has been an increase. So of course, this amount is also going to be your income, but not tangible income. So let's not call it net income, because net income is all realized profit. Okay. So what do we say is, okay, either you just show it below your net income, or I will let you create it as OCI. So again, we are putting all of this and we're creating a layer below net income, and we are calling it OCI, other comprehensive income. So this change isn't for reasons which is not just realized. This change is for reason which has yet not materialized, and I call it OCI. So in OCI, there are actually, and I won't let you just take anything. I've defined the boundary. So typically I call it PURIET. Now this is a short form. There are a number of reasons. So 1, 2, 3, 4, 5. And if you're following Ind AS or IFRS, there would another, so it will be PURIET R, which is revaluation surplus. Okay, we'll talk about it, right? So 2 examples I told you, right? First example is I let you increase my asset, and at the same time I let you increase my equity, but then I don't want you to just show it like just like that in equity. So what we are doing, we are taking, so this becomes unrealized gain on available for sale debt securities, which is one of the reasons. I've defined you the reasons. US GAAP says it should be 5 reasons. Ind AS and IFRS says it could be 6 reasons. But these are the 6 important reasons, and these are the only reasons. You don't have a choice to do it. These are the only reasons where I let you park this profit in a separate statement which is shown after the net income. So we add these two actually. See, we add the net income and the OCI, and we call it comprehensive income. So I add the realized gain, generally all losses. So this will have all the realized gains and loss effect. And then we include the unrealized gains and losses effect for only the current year. Okay, for only the current year. And then what you show is comprehensive income. That means comprehensively the company earned or lost a particular amount of income, which is comprehensive income. And then just like net income flows through to retained earnings, similarly, if you look at it, so OCI will flow into AOCI every year. So if you look at it, this is how it looks like. You have balance sheet, you have equity, and the equity would have your retained earnings, AOCI. There are other stuff, right? And if you have your income statement, you will have your net income, you will have your OCI, and you will add these two to give you CI. The net income will flow through and become a part of your retained earnings every year. So this is only for the year statement, which means you don't have any opening balance. We started this year and then it ends this year. Next year, we will again have a new income statement. So the net income gets routed through the retained earnings. So it gets slapped on the retained earnings, and the retained earnings will continue year on year. The OCI would get slapped into AOCI, and this will continue year on year. The first example I give you was investments. The next example I might give you is revaluation surplus, which is again applicable only in India as well as in IFRS, because US GAAP specifically discourages it. So US GAAP prohibits the revaluation of assets in their books. So if you look at example 2, let's assume you had an asset. Think of these LIC buildings, guys. There was a time in India when you were allowed to book these at $1. So somebody just donated some buildings to LIC, and LIC was allowed to book an asset. So imagine that building would get booked in LIC books to donation. Okay, so to donation received, and we would book it in our books at 1 rupee. Now LIC is trying to go and get into an IPO, which LIC did a couple of years back. So if you're going for an IPO, you have so many good, nice properties, but they're showing in your books at 1 rupee, and you don't want that to happen, right? So what do? You say, okay, I will allow you to revalue, because you need to establish your valuation. So let's assume that building is now worth maybe $10 million. So I'll have 9.99999 million, right? So $9.9999 million, and I will allow you to book it under OCI. So this is a gain. This is a gain, and this OCI gain would be on account of revaluation surplus. And when you do that, the value of your OCI would increase and the equity would increase. So ultimately, the LIC building would continue to show in your books at 10 million, and your equity has also gone up by 9.9999 million. That means what? We increased the asset and we increase the equity, but this increase is not routed through the income statement. So this increase is not routed through the income statement. Why? Because it is unrealized. So what would happen, guys, when you realize this money? So the question now becomes, what happens when I sell this building? Now see, this is easy, right? Imagine now you sell this building. So we have a balance sheet and we have an income statement. When you sell this building, there was AOCI, the building was for 10 million, AOCI was from 9.999 million, and now you sell this building. When you sell this building, you've actually realized the gain of, and let's assume the selling price is also 10 million. That means you've realized a gain of 9.999 million. So what do you do now? Now we are ready to take this out of balance sheet and put it in the income statement. Why? Because this is now realized gain. So what we do, the building goes away from your books. Cash comes in at 10 million. So we have changed the form of the asset. If you look at the equity here, the equity would have retained earnings and AOCI. So what would you do? You will remove the AOCI from here. And if you look at it, gain on sale of building. Now this is realized gain, okay? This becomes 9.999 million. And because of this, your net income is going to go up by 9.999 million. And because now the net income has gone up, you will see that this net income would again go and increase your retained earnings by 9.99 million. In other words, what are we doing? We are just reclassifying an equity from AOCI to retained earnings. And this is called as reclassification adjustment. So technically, what is net income? It is that part of income which generally we have realized during the year. What is OCI? It is 5 or 6 components which increases the equity because of unrealized gains and losses, yet not ready to be routed through the P&L because these are unrealized. So we let you increase your asset or decrease your asset and park the corresponding effect in the OCI, which is a separate section of the income statement. Now, many people just club the two and show it in one statement, but most entities would show it as a separate entity, separate statement. So they'll first show you the statement of net income, and then they will take net income, add or deduct all the OCI gains and losses and arrive at CI. And ultimately, when you sell the asset would now actually get realized, the gain would actually get realized, or the loss would actually get realized. And now we'll take it out from AOCI and pour it into income statement. And through that, it will increase the net earnings, and hence it would increase the retained earnings. So this is called reclassification adjustment. Now this is how, as far as the theory goes. So we know NI, we know OCI, we know CI, which is NI plus OCI for the year. We know AOCI, it is that part of equity which accumulates OCI over all these years. But now comes the most important question. The first question is, why CI? Why did we have all of this? Okay, because that's some other question, right? Why was the need to have this CI? And the second thing, which is very important, is why do you need to differentiate between AOCI and retained earnings? Ultimately, it is all going into equity. Why did you have to separate the two? Now see, this is why it's very important. What we saw was just a very rosy picture. Why? Because we were all talking about profits. But think about loss. Think about all of those investments which you carried in your books, but which had accumulated losses. And if you never show it in your books, your assets are escalated, your net income shows a great picture. But the day when you are going to offload those assets from your books, the net income is going to take a very bad hit, and the investors would be caught off guard. So that's the reason why most accounting standards throughout the world have made it mandatory that if there are any anticipated losses on account of those assets that you are hanging on to, but which has eroded in value till now in the market, please don't show it as a surprise when you sell these assets. So what do? You reduce the value of those assets and you book OCI losses in your books, in which case the net income would be much higher than the comprehensive income. So we want the investors to be aware of this bad news so that when they factor in to decide whether they want to still get invested in the business or not, they would be able to make an informed decision. So think about all of the OCI losses that could be there. And I will tell you the reasons, right? So we remember we said PURIET, And if you are following Ind AS or IFRS, you also have another R. So these are pension assets. Imagine if you're having some pension assets or liabilities, and if these undergo a change, and even your liabilities, okay, you'll see, we're not discussing this in great details now because I want you to just keep yourself focused on NI, OCI, CI, and AOCI. But think about all of those pension assets and liabilities in your books. This we already discussed, unrealized gains and losses on available for sale debt securities. Now, this is a fancy way of writing it because you have to make it a little complicated, of course, right? But actually, these are just long-term investments. And this is one area where US GAAP and Ind AS and IFRS have a huge difference, okay? More on this on some other video. If you guys are interested, let me know. I would do that. Now, I is for instrument-specific credit risk, okay? This is instrument-specific credit risk. Now, again, this is another lecture in itself if you want. This would be the effective portion of cash flow hedges. Again, looks like a very fancy name, but easy actually if you understand this really well. And T is translation gains or losses. Now, this is also very interesting. Think about Unilever PLC investing in Hindustan Unilever. And because of the fact that Hindustan Unilever financials are in INR and Unilever PLC is in dollars, if you're going to convert the INR to dollar and show the consolidated picture in the books of Unilever for the year, there of course would be some gains and losses. But again, these are unrealized because this gain and loss is going to be there unless and until Unilever decides to sell off the Hindustan Unilever. And of course, R is revaluation, gain or losses. So we call it revaluation surpluses or deficits. But this is applicable only for Ind AS and IFRS. So these are the only reasons, guys, okay? This is only for Ind AS and IFRS. So this is these are the only excuses, or these are the only areas where you are allowed to make the adjustments only through the balance sheet, not routed through the P&L account. Now comes the next very important question. Why do we want to differentiate? Why do we want to complicate so much of the equity portion, retained earnings, AOCI? Ultimately, it will all go to the shareholders, right? Then why are we differentiating it? The reason is this is freely available for dividend distribution, which means I can use this money and distribute dividend as and when I want. I don't need anybody's permission. Who am I? Am I the board of the organization? But this cannot be used for dividend distribution. So this is important, right? We are letting the users know that, see, this seems to increase the money that is available for the equity shareholders. But please remember, this has gone up for reasons which has nothing to do with. So this has nothing to do with shareholders, yeah, with equity shareholders. Neither are they putting in this money, nor are they eligible to withdraw money from here by way of dividends. So what is AOCI? It is that part of equity which resembles transactions owing to non-owner transactions. So there are two keywords which are very important for AOCI. One is non-owner. The reasons why they increased equity has nothing to do with contribution from the owners or distribution to the owners. And second, these are unrealized. It's all on paper. It has nothing of this has been materialized till now. So this was the nutshell of what's the difference between NI, the OCI, and CI. If now you look at a lot of analysts, they give more credence to CI rather than just the NI. If it's a profit, it's good news. Hang on to it. But be very aware of CI being lower than the NI, because in that case, you cannot ignore it if you're a financial analyst. AOCI, again, a part of equity, just is not available for distribution, free distribution of dividends to the shareholders, and the effect of AOCI would flow in, effect of OCI would flow into AOCI every year. With this, hopefully this would have solved a lot of your confusion. If like this, if there is any other topic that you would want me to take, do mention in the comment below. Subscribe to our channel if you want to listen to, or if you want to go through more such conceptual videos. See you then. Bye-bye.